Hello, I'm Lelde Smits for Modern Wall Street, and joining me here at the New York Stock Exchange is famed economist, investment banker, lawyer and author Jim Rickards. Jim, wonderful to speak with you again.
Great to be with you, Lelde.
Now, we have spoken in London. We've also spoken in Sydney. I know you travel around the world. We've got fears of global growth shrinking that are intensifying. Are you concerned, or is this an overreaction?
It's not an overreaction at all. This is a very big deal. We're in the second recession inside the new depression. So you know my view, we've been in a depression since 2007. People say, how can it be a depression? Growth isn't declining around the world. That's not the definition of a depression. You can be in a depression when growth is below trend. So if trend is 3.5%, 4%, you're growing about 1 or 2, that's depressed growth, lost output, enormous lost wealth. So we've been in a depression by that measure since 2007, but now we're in the second technical recession within the depression. It's just starting. By the way, the official referee, the National Bureau of Economic Research, they usually call it about a year after it starts. So don't wait for them to tell you it's a recession. You can see it today.
Okay, now as we speak, the US Federal Reserve is holding a two-day policy meeting. We've got an interest rate decision due tomorrow. Do you believe we're likely to see any market-moving outcomes emerge?
No, look, clearly they're not going to raise rates. I said a year ago, in November 2014, that they were not going to raise rates in all of 2015. Of course, Wall Street was saying March, then they said June, then they said September, now they're saying December. The Fed's not going to raise rates. The Fed can't raise rates because the economy is weakening. You don't raise rates in a recession. The time to raise rates was 2010, maybe 2011, when the economy had a little more strength. The Fed missed an entire cycle, but two wrongs don't make a right. The fact that they blundered then doesn't mean they should blunder again now by raising rates in a recession. They've got to go to ease at this point.
Now, Jim, this is quite a contrarian view because most are expecting them to raise. So when do you think we are likely to see this next move, which may be easing as you predict?
I think the next move will be easing. I'm looking at March 2016. Look, I take it one day, 1 week at a time in terms of data, but just to kind of give you a rough rule of thumb, QE2 ended in June 2011. QE3 started in September 2012. So that was a 15-month gap between one and the other. So take the end of QE3, which was November 2014, come forward 15 months, you get to around March 2016. I'm not saying it's like clockwork. I'm just saying the Fed doesn't change quickly. They want to see how things go. By the way, the Fed will be the last to know we're in a recession because their forecasting models are deeply flawed and obsolete. So a lot of people see it, but the Fed will be the last to know. But by March, they'll be ready to ease.
Okay, so Jim Rickards, if the Federal Reserve doesn't increase rates and, in fact, the next move is easing, what are we likely to see will be the repercussions for global markets, in particular US markets?
Well, it's very interesting, Lelde, because you say, well, gee, you're at zero. How can you ease? Well, the fact is, even at zero, there are 5 ways to ease. They can do QE4. They can do helicopter money. They can do currency wars, cheapen the dollar. They can do negative interest rates. And then the other way to do it is forward guidance, which is just talking. I actually expect they'll reintroduce forward guidance. They took it away in March of 2015. Remember the famous word patient? They took it out of the statement. They could get the thesaurus, look up some synonym for patient, stick it back in the statement. So I would look for forward guidance and a cheaper dollar. Repercussions, look for a cheaper dollar, stronger euro next year. It's going to put pressure on people like the Reserve Bank of Australia to cut rates and try to cheapen the Australian dollar, cheapen the Canadian dollar. That'll go on around the world. So,
would you say this view, though, generally isn't considered as the consensus? And if it's not consensus, how might markets respond to that view?
Well, it's a very good question because the markets will be taken by surprise. The thing about the consensus view, well, I mean, just look at the data right now as we're speaking. A majority of economists expect the Fed to actually increase rates sooner than later. Yet the Fed funds futures market is saying no way. They see a very low probability of that way into 2016. I'll go with the Fed funds futures markets because that's where people put their money where their mouth is. The problem with Wall Street economists, a lot of them were trained at the Fed, or they went to the same schools, or they had the same professors. They're using the same obsolete models as the Fed. So it's not surprising that the economists get it wrong. The Fed gets it wrong. If you have the wrong model, you'll get the wrong result every time.
So you've obviously thought about this and you've made a pretty big call. You must have thought about the implications on precious metals. What is your outlook for gold and silver should the Fed move as you expect?
Well, it's very straightforward because gold is just a form of money. Silver is not quite the pure play that gold is, but I mean, silver will tag along with gold. So let's talk about gold. Gold's a form of money. So when I say the dollar is getting weaker, that means the dollar price of gold goes up. Now just go back and look at August 2011. That was the all-time high for gold in terms of dollars, but that was the all-time low for the dollar in terms of the Fed's broad trade-weighted index. So gold is just a crossfade. It's like you could have euro dollars, you could have yuan dollars, you have gold dollars. So if the dollar gets weaker, then the dollar price of gold is going to go back up again. So from where we are now, you got the strong dollar, low dollar price of gold, weaker dollar, higher price for gold.
Well, Jim Rickards, I will certainly be keeping my eyes on the markets and your predictions over the coming months. Thank you very much for your insights, and wonderful to have you here at the New York Stock Exchange today.
Thank you, Lelde.